So we've talked about sales and marketing efficiency and quality of revenue. A lot of companies will ignore or not focus as much on the whole operating structure of their business. So a couple of key metrics that we like to look at is one, operating leverage, and the other one is what we call coverage ratio. So we're going to show you a few diagrams that are going to help illustrate how does the software company scale over time and how do you balance revenue with your cost structure. So the first part is considering operating leverage. And what this means is in the early stages of a software company, more money is going into the cost structure itself while you're developing a product. But at some point, you're going to start bringing revenue on once you hit MVP. From that time forward, generally speaking, you're going to want to have revenue growing faster than what your cost structure is growing. And this is what we're talking about, getting leverage out of your cost structure. So we're going to show you a diagram that shows the different pieces of how or the life cycle of a software company. So the beginning stages is what we would say startup to MVP. And at this time, you should be considering down at the bottom this minimum viable infrastructure. So a lot of people talk about MVP and they'll think about that, but they should also be considering what is the minimum infrastructure in terms of G&A, R&D, and sales and marketing that you're going to have once you get to that MVP, and what's it going to cost to scale that up. Then you're going to go into a time where you start going into hyper growth, where you're getting 300 or more % return. It's easy to get returns when you have 100 million or 100,000 in recurring revenue. If you get 300,000 or to $1 million, you're seeing these huge growth rates, but not necessarily in terms of absolute dollars. And so you're in this hyper growth stage where you're 200, 300%. At that time, something that we want to help a company do is look at rationalization. This is when you're trying to build your revenue to catch up with the infrastructure you have. And a good way to look at this is what we call coverage ratio. So in the early stages, your ARR might only be covering 20% of your infrastructure, and you want to get up closer to 100% coverage. The next stage would be high growth, and this would be usually in that 120 to maybe on the low end, maybe 70% growth rate. And then the next stage after that is when you're growing to scale. And at this time, you want to be introducing new product lines and revenue streams. And gradually, once you go below maybe a 50% growth rate, then you start focusing more and more on profitability. So why don't we take a look at how this would look if we graphed it out. If you can see down here in the bottom left how the cost structure in the black line is well above revenue. And you can see over time that's converging together through that rationalization period. Once you get to the point where your coverage ratio is about 100%, maybe 120% of your operating structure, you'll want to grow as fast as you can, but keeping your cost structure and your revenue growing pretty close together because you're focused still on growth. Once you get to the point where it's hard to grow it faster than maybe a 50% growth rate, you'll want to start focusing more and more on profitability, and that's where you'll see that the revenue starts to grow above what your operating structure is until you grow into a full-scale business model where you're generating maybe 20% operating profit.